Hello everyone, I'm Sahil and welcome back to the channel. This episode is to continue the series of videos that I'm making for somebody who's a beginner in investing. So according to Robert Kiyosaki, right, there is four main asset classes that builds wealth for any investor, and ideally all the investors should be invested in all the four asset classes to diversify. So what are these asset classes, right? Firstly, it's business, then we have real estate, then we have commodities, and lastly, paper assets. For business, right, it's like all the wealthiest people in the world, they made their wealth by starting a business. Like Jeff Bezos with Amazon, then we have Elon Musk with PayPal, and then he started Tesla. Not started, but became part of Tesla. And then we have Bill Gates with Microsoft, and so on. But it's not all that easy, right? If not, everybody would be a wealthy person. Like just start a business and here it goes. The thing is that 65% of businesses fail within the 10 years of its starting up. So when this happens, right, the founder actually loses a lot of money and he's actually in a worse financial position than he began with. Even if the venture doesn't fail, it is so hard to have a business that is so scalable, something like Amazon. And yeah, most of the time, all the businessmen are just left being a self-employed person, doing a task of three people while just drawing a salary of one, and he's just stuck in the business, not as a business owner, but as a self-employed person. So yeah, there is definitely a chance of you becoming very wealthy when you start a business, but it is also very hard, and there are also a lot of opportunity, time, and cost to the founder. Secondly, we have real estate, right, which is investing into a physical property with the use of leverage and renting it out in the hopes that the rent covers all the mortgage payments, the other costs like repairs, taxes, and so on. And then you're still left with something to benefit you. In the long term, you end up with a property while somebody else have been paying the mortgage payments for you. So that's what the basis of real estate is. But it's also a very headache. What if you can't find a tenant for 1 or 2 months? You have to pay the mortgage from your pocket, which could be a huge drag to you. So there are some risks to that as well, right? Thirdly, we have commodities, which are just basic goods such as oil, grain, natural gas, or gold. And when investing into a commodity, a physical commodity, you have to worry about the transportation, storage, and amongst other issues. Then lastly, we have paper assets, and that's exactly what we will be covering in this episode, since it can give you an exposure to all the other asset classes at the same time. And the barrier to entry, the amount of money that you need to start investing into this asset class is actually extremely low. So let's hit it up. There are 6 major types of investment products that are available to you to invest in under the paper asset class. Firstly, we have equity, then we have bonds, and thirdly, we have mutual fund and a unit trust. Then fourthly, we have ETF, then REITs, and lastly, derivatives. So let's look into each of them and find out more about them. So let's start with equity. Now, I mentioned earlier that starting a business is very risky, but we can definitely reap the benefits of the success of listed companies like Amazon and Apple simply by investing into them. And by the time a company is big enough to be listed, the risk of failure of that company becomes comfortably low for us. There is still risk, but now it's way lower than a startup, right? With equity, you're essentially just buying a portion of the company and becoming a legal shareholder of that particular company. For example, let's take Apple. So Apple currently has 275 million shares, and each share costs $122. So if you buy 100 shares, it will cost you $12,200. So with that, you have ownership of 0.0000006% of Apple. Obviously, this is very small, right? That's 6 zeros, so it's very, very small slice of the cake. But in theory, if you have enough money, you can just buy the whole cake if you want to. As a part owner of a company, obviously you have some rights on the profits that a company generates, and it's limited by the stake in the company that you have. So if you're a stake in the company, you have the majority one, right? Then you decide what happens to the profits. Where does it go? And for a company, usually it's decided by the board of directors, which represent the owners of the company. So the board of director can actually choose to give out some of the earnings of the company to its investors in the form of dividends, or they can reinvest everything they earned into the business to grow it further. So yeah, however, the dividend is dependent on the earnings, right? If the business is making profits, then you have something to give out to the investors. So if there's no profits, then no dividends as well. On the other side, whatever money is reinvested into the business, right, it will help to increase the business. And if the business grows, the value of the company will grow. And with that, your per share price will increase as well. So when the share price increases or decreases, that's considered as capital gains for you. Okay, so let's just summarize all the pros and cons of investing into equity. So for the pros, we have firstly that you get dividends, you have capital gains. Then also, like, it's a very liquid thing. You can buy and sell it any time of the day within seconds. Not any time, as long as the market is open, right? So you can just buy and sell your shares and liquidate whenever you want. All right. You also get voting rights. So collectively as shareholders, you can decide where the company should be headed towards. Also, it's completely passive. Like, you are not doing anything. You're just sitting. You give your, like, you buy the assets and then you just sit there, and the money just keep coming to you. It's the managers of the companies that are running the company itself. The cons, it's risky as compared to other asset classes. Definitely is. And then you also have only the residual claims over the assets of the companies in terms if it gets liquidated, right? So that's about it for equity. Let's move on to bonds. Bonds are certificate of debt. Just like you and me can go to a bank and take a loan to buy a house or a car, a company can take a loan from investors like us to fund their new projects or their operations. In return, they give us regular fixed payments called coupons, which are similar to interest that we pay on our loans. And at maturity of that bond, you get your principal amount back. For that very reason, bonds are also known as fixed income assets. Now, why borrow from people like us and not from a bank directly? Well, this is because the amount of money the companies borrow are often way above what a bank can offer to them. Based on who's taking the loan, you can also divide bonds into two different types, the government bonds and corporate bonds. The government bonds, like the name suggests, are issued by the governments, and they carry no risk other than, I guess, the currency risk if you're a foreign investor. There is no risk because government can always print more money to pay off its lenders, and I know that's a bit shady, but that's what it is, right? Printing more money would induce inflation, right? And this is reflected in the interest that you get paid. So the real interest rate, which is also known as the risk-free rate, includes inflation, the expected inflation in that. That's why you see like what's happening in US right now. The 10-year treasury yield is spiking up. This is because the inflation expectations are increasing, and there's a sell-off in the bonds. So the bond yields will reflect any possibility or expectations of inflation. Since the risk is lower, right, that means the interest rate you get is pretty low as well. So if you look at Singapore, for example, right now the 10-year yields are at 1.58%, which is pretty low, right? But investors are okay with that because the other alternative that they have with similarly no risk is leaving their money in the bank account, which is currently paying 0.5% interest rate. So yeah, at least by being in bonds, you are beating the inflation. So yeah, the second one is corporate bonds. For corporate bonds, they are issued by companies, private or public. Since there are chances that a company might default on their payments and might go bankrupt, right? They carry more risk than the government bonds. And to incentivize investors to still lend them money, they have to pay more interest rate. This is called the default risk premium on top of the risk-free rate, amongst other risk premiums that there might be, like maturity risk premium, but don't bother about that. The two main thing you should know about is the risk-free rate and the default risk premium. So yeah, that's it. Now you also know that any two companies don't have the same risk of defaulting on a payment, right? A company that is doing bad, like the business is bad, might have more chance of defaulting on a payment than a company that is the business is doing awesome and they just need more money to expand their business, right? So this is actually reflected in their credit rating, which companies like Moody's come up with. And a company that is rated higher will have to pay less default risk premium than a company that is lower, that has a lower credit rating. The third product that you can invest in is mutual fund. So in a fund, a pool of money is collected and is managed by a professional fund manager. The fund manager allocates and structures the fund's asset according to a base philosophy or objectives in order to get best returns for its investors. And this base philosophy or objectives are pre-stated in the fund's prospectus. So like investors like us can go through and read what is the particular fund aiming for, and if it meets our objective, we can invest in that. Obviously, for the service of managing this fund, there are management fees. And yeah, the good thing about mutual fund is, right, you get to diversify right from the get-go. So a mutual fund is pretty diversified, right? Because they have so much money to invest in. So they are invested in equity, bonds, and other securities like commodities. So even if your investment is pretty small, you still get the benefits of diversification. At the end of the day, each shareholder benefits from the gains or the losses of this fund proportionally. So investors of a mutual fund earn a return in two different ways. Firstly is the distribution, which covers all the dividends and realized capital gains. Realized capital gains is anything that increase any of their holdings which increased in value and they sold it off. That capital gains will be distributed back to the investors. The second way they earn is by price appreciation of the mutual fund. If the holdings increase in value and the fund doesn't sell it, then obviously this would be reflected in the price of the mutual fund itself. So you can sell the units of mutual fund that you have in order to make a gain. There are unit trusts as well, and I think you might have heard about them, which is very similar to mutual funds as well, just that they are not incorporated and established as a trust deed, just like the name suggests. And they are pretty much the same, and just that as an investor, you are a beneficiary of a unit trust. Now let's look at the pros and cons of mutual funds. For the pros, right, you get your diversification. It's professionally managed, so you don't have to really buy, sell, or do anything. You can just forget about it. You don't have to manage a portfolio or something. For the cons, right, obviously you have to pay the manager, so there's management fee. And also a significant portion of a mutual fund stays in cash, which doesn't earn you anything. Thirdly, it's not easy to compare two funds. It's purely based on who's the fund manager and what is the philosophy behind it. You never know what they're gonna it's just you have to know from that what where they headed towards. So yeah, it's not that easy to compare two funds. Now moving on to ETFs are quite similar to mutual funds as well. So I will just highlight the differences to you guys. So ETFs, firstly, right, they stand for exchange traded funds. So that means that they're traded on exchange, just like stocks. So you can buy and sell them at any point of time during opening hours, when the stock exchange is open, right? The price will fluctuate and you can buy and sell at any point of time. Whereas mutual funds are traded over the counter. So you can only buy them at the end of each trading day based on a calculated price. Mutual funds are also always actively managed, and so the fund manager is actively making the decisions how the assets are allocated within the fund. Whereas ETFs are mostly based off of indexes, and it's passively managed. Obviously, there are some ETFs that are actively managed as well, like the ARK ETFs. All their ETFs are actively managed. Since ETFs are passively managed, right, the fees are lower, the management fees, whereas actively managed funds, even actively managed ETFs, the ARK ETFs, the management fees would be higher. The next we have is REITs, which stands for Real Estate Investment Trust. A REITs own, operates, and finances income-generating properties. So this is very much similar to owning a property for rental yield, and in many terms, it is actually better since you can get exposure of real estate on your assets, and you can do it with any amount of money you have. You don't have to have like 100K or something for a down payment before you get exposure to real estate. Also, you don't have to deal with tenants, the unexpected repair bills, and all sort of other problems that comes with investing into a physical property. REITs also gives out most of its earnings as distributions to its investors, because they have tax benefits on doing so. And many of them do their payouts on a monthly basis. So it's a very good investment for income investors. The yields are pretty high as well, usually around 7 to 10%. However, the capital gains are not there since, like, there's very little money for them left with them to reinvest. The last one we have are derivatives. Derivatives are contracts that are derived or based on other financial assets. Futures contract, stock options, CFDs are the most common ones that you will come across in your investment journey. So in future contracts, the buyer agrees to buy the underlying assets such as oil at a predetermined price on a future date. So I can decide, I can make a contract with a supplier. Okay, this is the price I'm going to pay for the oil that I will purchase 1 year from now. Secondly is stock options, which is similar to future contracts but more complex and solely based on equities. Equity market, the underlying asset is the shares of companies. Here, someone who owns like 100 share, which is one lot, can actually write a contract which can give an option to another person, the buyer of that contract, to buy these underlying lot of shares at a predetermined price, which is called the strike price, on until a future date. So a contract that gives an option to the holder, to the buyer of the contract, to buy the shares is called a call option. And if it gives the option to sell the shares, then it's called a put option. It is more complex than this, and I can't cover everything over here. And I personally don't really have very in-depth knowledge as well. I've personally not traded options myself because it's only limited to the US market, and I'm not invested in the US market. Anyways, to purchase this contract, right, you have an upfront cost, and that is the reason, like, the owner of the a lot of shares actually writes the contract. This cost is called options premium, and the underwriter of this the contract earns this premium regardless of the person buying or exercising his option or not. In Singapore, you might come across something called as SIP, which stands for Specified Investment Products. These are derivatives as well, and since they carry a higher risk, right, you need to go through something called a CAR, Customer Account Review, just to show that you have some prior knowledge and experience before you try and lose all your life savings. Anyways, under the SIP, right, you also get future warrants and DLCs, which stand for daily leverage contracts. DLC tracks underlying asset equity, actually, of either SGX or Hong Kong Stock Exchange, and it's leveraged at 5x normally. Alright, so these were the most of the products that are out there for you guys. As you're just starting up in investing, right, I would recommend that you invest in ETFs that are based on a broader index, such as HSI or STI. I mean, there's not in gains. I know you won't be tempted, right? You'll be looking at 100% gains, but they're only giving you 5-7% gains. So, but the thing is, like, this is to get started. Since you don't have the knowledge, you are entering a world of risk. So you need to get the knowledge to reduce the risk for yourself. As a starting thing, just go and invest into an ETF. This will help you to like get used to putting money out for investments on a regular basis, and also get you used to the emotion that you go through when like price goes up or down. So yeah, which is very important. So I understand that you need to maximize your returns, right? You're here to make money, so and that can only be done if you are investing in winners. But choosing a winner is not an easy task, and not everybody can pull it off. If not, everybody would be a billionaire right now, or at least a millionaire. So yeah, in the next episode, we'll be looking exactly at that, like the different ways of stock picking. If you're interested, just stay tuned, and until the next episode, ciao.